we're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So
welcome to the Crypto Teacher Stock Channel, and I'm coming back with a video on this channel just to make you think. And this one is on Cathie Woods. And we see that her portfolio is getting hit, but what do we know? On my main channel, the Crypto Teacher channel, I went over her portfolio. It's definitely about the New World Order's agenda. She's invested in the fourth industrial revolution without telling you, I'm invested in the fourth industrial revolution. Majority of her big plays are for artificial intelligence, autonomous driving. We know when it comes to energy, it's going to be a paradigm shift. We know banking, fintech, DeFi, paradigm shift. We know Bitcoin, also the other cryptocurrencies which are lifting off right now. Her current portfolio is being hurt by the yield rates, but at the end of the day, she knows she's going to win because she knows where this economy is headed. That's the reason why all of her stocks are based on innovation. So guys, when you're actually looking at investing, we're looking at the fourth industrial revolution, because we know when it comes to the New World Order, everything is planned out. Enjoy the rest of the video.
I wanted to ask about Bitcoin, a big picture question over the next decade. Do you think it will prove to continue to be correlated with risk assets, or will it emerge to be negatively correlated in a way that you could argue gold perhaps has been over the long term, or the dollar has been in terms of its correlation with stocks?
What's been interesting about the correlations, Bitcoin to any other asset class, is the correlations have actually been very, very low over time. In fact, the highest correlation is between Bitcoin and real estate. Now, the IRS taxes Bitcoin as property, but I don't think that's the reason for this correlation. It just so happens it's that. So we think that as it becomes a better accepted new asset class, and we are seeing institutional movement into the space, and we're seeing the diversification of balance sheets from cash into Bitcoin, we do think it will behave. Actually, I would say more like the fixed income markets, believe it or not. If you think about bonds from this level, you know, this idea of a 60-40 balanced portfolio is a bit problematic. We've been through a 40-year bull market in bonds. We would not be surprised to see this new asset class become a part of those percentages, maybe 60 equity, 20-20. So I actually think that might be the biggest surprise here.
I wanted to ask about fintech as well. I know you're a big believer there, and I wondered whether you look at the incumbent financial companies and banks in a different light than perhaps you do the incumbent autos compared to Tesla, or the incumbent retailers compared to Amazon 10 or 20 years ago. Are any of the traditional banks, with all the investment they're putting into tech, whether it's Goldman with Marcus, Citi with their partnership with Google, or the investments the big banks have made into Zelle, whether any of those banks are investable as plays on fintech, or are they all going to get crushed like certain retailers and autos have been?
Well, it's interesting that you say that. We have often expressed a point of view that there's old DNA and new DNA. It's when the technology platforms shift, it's very hard for DNA to shift from old to new. That said, you've seen with Walmart, you're going to have a Walmart, a Target, a Costco. So you'll have maybe 2 or 3 mega banks. And yes, a lot of them are investing aggressively now, which is what they should be doing. But we do believe that the 2 of the biggest sectors that will be disrupted in the world today are the two that have been best performing this year: energy and financial services. So choose wisely and make sure you're on the right side of change. Make sure these companies are investing enough, have invested enough. So many companies simply leveraged up to buy back shares, and now they're facing this huge investment mandate. So make sure that you invest in those that will be the survivors. And we do think that the carnage is going to be pretty significant in both the energy and the financial services sector long term. Now, in a V-shaped recovery, and we think we're in a very strong recovery right now, they're going to do fine. They're going to do fine. And in fact, the yield curve is very wide by recent standards. So that should accrue to the benefit of financial services broadly. So we're not saying that this is a fake out short term, but we are saying long term, watch out.
Cathie, just back to your fund's performance just recently and what we've been seeing. How are you navigating these heavy, first inflows and now outflows? And yes. my other questions are related to that is why are you selling liquid stocks for illiquid stocks in a downturn?
Well, it's part of our strategy. So in the coronavirus, we concentrated our portfolio towards our highest conviction names. So the flagship portfolio got down to 33 names. As the bull market extended, we added names. It's up to 55 names. Many of those names were much more liquid stocks. And so you're right, Sarah. When we get opportunities like this to invest in pure plays instead of more mature plays, still innovation, but more mature and not as pure play, we will move back into pure play. Those are the more volatile names, of course. And so we're getting great opportunities. And just to give you a sense of that, our minimum hurdle rate of return for any stock to enter our portfolio is 15% over a 5-year period. So that's a doubling over 5 years. Now consider the source, but given the very sharp pullback we have had here recently, nothing's changed from our point of view on our long-term projections. The only thing that's changed is the rate of return. So a 25% rate of return over 5 years. So we're becoming more and more optimistic about our portfolios in this sell-off.
We could go through a number of stocks that you like and that are all high interest on the street, from Palantir to Square. Why don't you give us, besides Tesla, which we know you're a big fan of and your conviction has increased there, which one you think is the most underappreciated name right now in your portfolio that you'd be looking to add positions to?
Well, we just went through this morning. Invitae in the molecular diagnostic space is probably one of the most important companies in the genomic revolution, and it is getting hammered. It's a company that has had historically small cash cushions, although they've rectified that with offerings, which is great. But it's investing aggressively to be the leader in the molecular diagnostic testing space. Many people, the disconnect for many people here is when they think of lab tests, they think of LabCorp and Quest Diagnostics, which are effectively very mature companies, commoditized, value stocks. And so it is a little bit like Tesla in the automobile industry. The new lab tests, which are going to be informed by artificial intelligence and big data and supercomputing power, are, we believe, in a winner-take-most market as we move into personalized medicine, much different from one test for all, although we'll see multi-cancer screening certainly in that realm. But we think the move towards personalized testing is going to give just a few companies the lion's share of the market, those companies with the most data, the highest quality data, and the best AI expertise.